Okay, everyone, we will now get officially started here for our three strategies to protect and grow your retirement nest egg. And so I'd like to welcome you here today. And I promise you this today that we're going to walk through these three core strategies and show you some very specific ways to build and manage your retirement portfolio. Before we get started, if you can close your close down any distractions, turn off all distractions. We don't want to be the driver with the as we text kind of thing. We want to close your door, turn off your cell phone, or at least put it on silent. I know you everyone's not going to turn off their cell phone for this, but at least put it on silent and stay focused. Give your full attention because I think that you'll learn something here that can make a huge impact, a positive impact on your investment portfolios. Let me just take a moment to introduce myself. I see some familiar names in the chat box. There are some that I don't recognize, but for those who are new, my name is Jim Penna. I'm the manager of retirement services here at VectorVest. I've been with VectorVest for 14 years now. Prior to coming into VectorVest, I've been in the retirement services division or department for, I don't know, 7 or 8 years now. Before coming to VectorVest, I'm originally from the Northeast up in Connecticut. If you have any Connecticut Yankees in there, you can type in. But I'm from there. I worked on a trading desk for Knight Capital, a large market making firm, for about 5 years before moving my family from up north down to North Carolina here. And I always like to add in that in a prior life, two prior lives ago, up in Connecticut, I was a police officer in my hometown of Norwalk, Connecticut for not quite 10 years. And so if at any point it sounds like I'm telling you to do something, that's kind of where it comes from. Okay. All right. Now, enough about me. Let's talk about building and managing your retirement portfolio. And here's where it kind of all began. I, when we were building our concepts here in the retirement services department, we had we talked about having a worry-free retirement, right? How can I invest in my portfolio, have a worry-free retirement? And I found this quote. I was always looking for quotes to lead into topics, and I found this quote by a fellow Connecticut Yankee named Mark Twain. And he said, "Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you, so you can gain information, focus, and control over the situation." He went on to say, "I've suffered a great many catastrophes in my life. Most of them never happened." And so that's really the goal of what we're trying to do here, at least build a foundation and get you started towards building and managing a retirement portfolio. So based on this and where the retirement services department actually started is with a long conversation that I had with Dr. Delito a long time ago now. And I was relaying to him that when we used to go on the road, our customers and our seminars were on the road at hotel ballrooms and things, and folks I talked to would always the question or the concern would always come down in some form or fashion. How do I keep from running out of money in retirement? Right? How do I keep from running out of money in retirement? I relayed that to Dr. Delito, and he said to me in only the way that Dr. D can, he said, James, just tell him to keep making more money. Right? And so that was kind of the genesis of all of this. And so my goal here is today, and for our retirement services department, is to promise you that you can retire with a peace of mind, knowing that you can steadily grow your portfolio, you can generate a safe, steady income, and that most importantly, in my opinion, as I'll talk about before we're done here today, is that you can preserve your capital. You can protect your net worth, your nest egg. There's a quote I'm sure I'll use again before I'm done here in the next hour or so, but the great hedge fund manager Ray Dalio once said that you can't make money in the market without taking some risk. Okay? But you certainly can't keep your money without being defensive. Okay, so if you don't mitigate that risk, the money that you make isn't going to last long. So it's very important. So again, you can retire with that peace of mind, knowing that you can reach those three core strategies that we'll talk about. We like to say that a secure retirement is one in which you have enough income to live the life you desire. Okay, it may not you may not desire to buy that yacht and sail around the world, but it's the cliche. That's why I kind of used it. And you'll see these folks were VectorVest customers. They named their boat after us, as you can see. Okay, but it's the life that you desire. Whether it's sitting on the front porch reading a book with an adult beverage by you, then that's every bit as good. Maybe it's playing golf. But a secure retirement is one where work is optional and retirement is affordable. Okay, those are the keys. Now, how do we get to that peace of mind? So to build that foundation, we start with what we call the three P's. Right? First is profit. The second is provide, and then finally preserve. So these are the three core strategies we want to talk about. On the profit side, we're talking about capital appreciation. We don't want your portfolio going on that roller coaster ride. Now, we all understand that nothing goes straight up and that any equity curve, whether it's a stock graph or your portfolio equity curve, is not always going to go straight up. But what we don't want is that violent roller coaster. So what we're looking for is more of that steady climb on the capital appreciation side. I'm going to talk about income, talk about several ways to generate income in your portfolio. We don't want like a lot of retirement minded investors have, where you've got maybe a couple of dividend stocks that might have some dividends that come in. You don't really, you're not really focused on that objective. So we want to take that trickle theory and turn it into a steady flow of income. And then finally, as I said, preserving your capital is issue number one. Um, so we want you to go from being unprepared and knowing what to do, like February of this year, right? No one could have predicted where the pandemic sell-off and the crisis that it caused would have gone back in early February in the markets. But we did have signals, and I'm going to talk about very specific strategic times where you can protect and preserve your portfolio. So we want you to go from being unprepared to prepared. That's my goal today, to set that foundation. I'm going to start by asking you guys to interact with me. Okay, to interact with me, where I'm going to ask you a question. What's the hardest part? In just a few words, what's the hardest part about preparing for retirement for you right now, or if you're already retired? I'm just going to pause for a second, type in a few things. Okay, yeah, if you're coming in here, how to keep busy, Mark says. Yeah, well, that's important. We don't want you spending all your time, building and managing your portfolio. We want to make it easy as it gets. Uh, Dietrich says defining a strategy. I think you're in the right place for that one today. Um, Steven says growing my nest egg while I live off it. Right, that's not an easy thing to do, but we're gonna try to lay the foundation to make it easier for you here. Donald says the uncertainty of it, black swans such as the pandemic. Donald, we're going to talk about that today. Protecting my money, Kobe says. Um, yeah, George has one. Dr. Delito used to talk about that one. George says knowing how long I'll live, so it's hard to prepare around that, and that was really part of the conversation that came from just keep making more money so you don't run out in retirement. And this is something these strategies are something that you can continue to do. But that's one of the factors, George, that we it's a great comment and we hear it often, but it's one we can't really build around because we don't really know. We have to plan on, God willing, being around a long time. Um, Richard says being focused enough. Yeah, a lot of that comes from when you don't have a specific process or a plan. Okay, and so there's more coming in, and these are great ideas. So from the answers that I'm seeing in here, it sounds to me like you guys are in the right place today. So I'm very glad that you took the time. So let's jump into this and begin with core strategy number one. So I'm going to first talk about capital appreciation. Okay. The second core strategy we're going to talk about is income, and then as I showed on our little pyramid earlier, capital preservation. Let's start here though. Let's begin with capital appreciation. We're talking about profiting, right? Growing, buying stocks, buying good quality stocks that are rising in price in a rising market. That's really the basis for the first core strategy I'm going to discuss. And it comes from owning companies with consistent and predictable financial performance. That's how we describe or define uh, what we call relative safety in our program. I'll talk about that in a minute. But consistent and predictable financial performance. And I always say, what two better adjectives to describe the type of companies that reside in your retirement portfolio? Okay. Now, I also played some baseball way back when in college, and I'll use a lot of baseball analogies. But Dr. DeLito has written many times and has said many times, good portfolio management starts with buying the right stocks. I always like to compare it to, and you could use any sport you want, but I use baseball. You put the best team on the field. That's how you win. And with my apologies to anybody who might be from the Chicago area and happens to remember the 1969 World Series, uh, the Mets beat the Cubs to get to the World Series and beat Oakland. So if you're in Oakland area too, but the idea being when you put the right players on the field, it's the same idea. You build a roster, you build a team. The best players are out there, right? So when you had Tom Seaver, going out there on the mound every 4 days, and a lot of these other guys, I won't bore you with naming them all, but that's how you win by putting the best team on the field. Okay. So we say it's all about safety first, right? In other words, for our retirement account, primarily our growth portfolio, we're going to look at a company's safety more than anything else. So while it's fun to hit the home run, to keep the baseball analogy going, what happens to most home run hitters when they don't hit a home run? Even more so now than 40 or 50 years ago, right? Can anyone tell me? Type in. What does a home run hitter do when he doesn't hit a home run? Right, he strikes out. There you go. Donald's got it. We don't want you to strike out. So we have what we call our safety checklist. There is there are certain things that go into, again, what I'm going to talk about, relative safety in the VectorVest program. I could just say here's relative safety. It's on a 0 to 2 scale, and this is how we do it. But it's so important that I want to take just a minute or two and talk about the important things that go into relative safety in the VectorVest program. So these among others are the factors that Dr. DeLito used to create the relative safety indicator. It's called it's earnings consistency, right? The company's ability to make money quarter over quarter, year over year. The company size is important. We want to check that box because even though a smaller company can be profitable, obviously, what we want to be careful of is thinking that just because a company is a large company, that means they're safe. Okay, company size is important, but think of, and as an analogy, you think of GE, right? It's a large company, struggled a lot, trying to start to do better, but just because a company is large doesn't mean it's safe. When we talk about stock safety, we talk about price behavior. Okay? Price behavior. We don't want the violent drawdowns, the drastic moves in the stock. So there's a way to take the Dr. D uses formulas that use the mean of the price of the stock, right? Compares it kind of to beta when you compare it to the S&P 500. But important mathematical factors that go into letting us know, does the historical price movement of that stock render it safe at any given time to purchase? Business longevity is important. How long has a company been around? Right? Better the devil you know than the devil you don't. Not that a new company can't be profitable, but there's pitfalls, there's obstacles that can be fatal if they're not able to overcome them. Dividend history is a big one. We're going to talk a lot about dividends today. If a company doesn't have to pay a dividend to be considered a safe company, to have a high safety factor, however, if it does, it darn well better continue to pay and preferably grow that dividend over time, because there is, as Dr. D says, no greater black eye for a company than to either suspend or cancel a dividend or cut a dividend. Um, it doesn't it doesn't project well on management and the future of that company. And finally, debt to equity ratio. We just want to be sure that if the economy or a specific company runs into some headwinds, that they have that favorable debt to equity ratio and the ability to overcome those hard times. Dr. D writes about a company overdoing it, right? Going out, borrowing money because you can on your corporate taxes, claim that and not pay taxes on it or whatever it might be. The problem is some companies go too far and they take out too much debt. And if they're not able to report net positive earnings after taxes and their debt payments, then they're not going to be profitable and they're not going to live up to what we call a high relative safety factor here. Now, you can go out and you can manually do the data on these type of companies to find all of that information, but I guarantee you, it's been my experience, and not just the 14 years here at VectorVest, but longer than that, that you will get buried, you will become very frustrated. It's very cumbersome to go out and do that. So as I said, we have um, the the indicator called relative safety in the VectorVest program is defined as an indicator of risk, and again, it's the consistency and predictability of financial performance. Those are the primary factors in assessing the safety of a stock. All of our information in VectorVest, our proprietary indicators, are rated on a 0 to 2 scale. You can see the breakdown here. Anything above 1.1 is good, up to excellent. So these are important parts here of understanding how we are able to compare apples to apples. When Dr. D created VectorVest, it wasn't always easy to compare one stock to another based on the fundamental history of the company. So he created relative safety. We pour all that data into the VectorVest software and it filters it out with actionable information. And the one I'm talking about right now happens to be relative safety. Okay, so that's the checklist that we go through to find those stocks. Here's just one example. And for those who are familiar with my webcasts or my courses or whatever it is, you know that ruler stocks is one of my very favorite searches within the VectorVest program. And this was actually, I just took this screenshot shortly before starting this webinar today. And you'll see this is from our Unisearch tool, a search called ruler stocks. And you can see the parameters here. You have growth rate. Earnings growth rate has to be at least 14% per year just to make the list. You've got a relative safety number of at least 1.4 or greater, which is considered excellent in the VectorVest program, right? Just to make the list. And then there's some other basic parameters here I won't spend the time on right now, but you'll recognize hopefully all of these stocks, good quality stocks, and you'll see in the Unisearch tool we're able to sort the stocks that do meet the parameters, and the very best combination of relative safety times the earnings growth rate is what brings these stocks to the top of the list. So they all have a relative safety of at least 1.4 or greater, and then we take in the earnings growth rate as well. So you can see those growth rates are very, very strong. And what I always say about the relative safety indicator in the VectorVest program is that generally what happens with a high RS stock is that all of the other numbers I care about will fall into place. And I kind of covered the relative value numbers here, but relative value is price appreciation potential. You can see they're all, well, with one exception, above 1 and very, deeply above 1 on most of them. You'll see the comfort index number, which is the price growth persistence. In other words, high comfort index stocks have a nice northeasterly direction on their graph patterns. And again, earnings growth rate, as we just saw. So that's the beauty, the power of these stocks, and like I said, you'll recognize most of these stocks. I pulled one example out. It happens to be a stock that I own, West Pharmaceuticals. It's down at the bottom. It has actually the highest relative safety of all the stocks out of the top 20 here. But it's at the bottom. Its earnings growth rate, it's lagging at only 19% per year. If you didn't note the little bit of sarcasm in my voice there, but it's at 19%. It's a great company. It's also a company that has paid or grown its dividend for over 25 years. It's called the Dividend Aristocrat. If you're in the S&P 500 and have grown, not only grown, but paid your dividend 25 years or greater. Now, West Pharmaceuticals isn't considered a dividend aristocrat right now because I don't know if it's in or recently has gotten into the S&P 500. But anyway, these are the type of stocks. This is what we find when we look for those. Now, I use West Pharmaceuticals when we take a look at a graph to get a sense, a visual of what I'm talking about. As of today, the relative safety number on West Pharmaceuticals is 1.48 on November 11th. By the way, I forgot to salute any veterans who might be in the chat room on this Veterans Day. Gave a shout out to any Marines yesterday. It was the Marine Corps birthday, but a salute to those who have served. Anyway, as of today, 148 is our relative safety number, and you can see I have a 5-year look back at the stock just to give a broader view of what we're talking about. So earnings per share is growing and moving in that proper direction, as does the price of the underlying stock. Okay, so that's what we look for in a high relative safety stock. Now, West Pharmaceuticals happens to be one of those high RS stocks that also pays a dividend. So I added the dividend payout down. Now, if I had gone out, which I'll show an example later when I talk more about dividends, but I'm only out 5 years here, and you can see West Pharmaceuticals has grown their dividend every year for the last 5 years, and for much longer than that. But I just wanted to give that visual of what these high RS stocks look like and how they perform. I added this slide in here because I get a lot of times someone will ask the question, why are they called ruler stocks? So I just felt like I should show this. It's because there's an old saying, if you put on a ruler, it was usually either on price or earnings per share. Right? The idea was that you can pretty much draw a straight line to the upside on how these stocks, how their earnings and how their price pattern moves. Now, as I said, we know nothing goes straight up all the time, but the trend for earnings per share and for price has got that smooth line up, and that's why um, they're listed there. Okay. I have a sense of sometimes I try to multitask. I'm looking at the chat box for some of the questions. John is my colleague John Marabu is in the background helping to answer questions. I want to get through the presentation, but I'll take a couple of these quick questions here. Heidi asks, but what if the stock is overvalued? Right. So in the VectorVest, if I go back to the slide, you'll see we have the value, the price of the stock, and then the value of the stock. And that's a great question, so I'll take 30 seconds out to answer it. The current price, as of a couple hours ago, not even, the price of Netflix was at $481.66. The VectorVest program values the stock at $305. So we say that that's an overvalued stock. And you'll see some of these are, some are not. Here's my answer, Heidi, is that I don't summarily dismiss a stock simply because it's overvalued. Right? But it does make me go to look at the first number I look at when I see an overvalued stock is the earnings growth rate. It's the very first number I go to. If they're growing their earnings, yes, it may be that we're paying a premium for that particular stock. But again, and I know I'll open up the program, but this I think is like a 1.4 relative value number, so that price appreciation potential is very strong. but a great point. I won't dismiss it simply because of that. If it's well overvalued and has a growth rate of low single digits or even negative, then I'll move on from it. And then Jeff had a quick question I'll comment on very quickly. Do I care about whether it's a buy, sell, or hold rated stock? And yeah, I do care. It again, it doesn't mean that. Listen, we got to getting off script here a little. We got a confirmed up call today. Right? If I were building my portfolio starting to, well, actually, it came at the close yesterday. I believe last I looked, I believe the market was still up today. We we would go ahead and build our portfolio. Would that mean I wouldn't buy Lowe's or Netflix or any of these other stocks today simply because they're a hold? No, I would go in and most likely just purchase the top stocks here. Can I cherry pick through? Sure. Can I just pick the buy rated stocks? Sure. I probably wouldn't go with a sell, but we'll talk more about that later. So but good questions. I just don't want to just pass over them for you guys. So here's another screenshot that came from just a little earlier today. What I wanted to show was an example of a portfolio that we use in our retirement coaching group that we have every Tuesday. We have a live session where we build manage portfolios. Right now we have one using ruler stocks. It was begun back on January the 3rd, just starting the year off in 2017. And I just wanted to share the returns of when you focus on high relative safety stocks and use the proper process or risk management techniques to build that portfolio and manage it, that you can have some really great returns. So I'm going to round it, if it's okay, to 116. That's what we were looking at earlier today. These are the current positions in that portfolio. Okay, that comes to about, if you use a 4 year, it's just about 4 years now, 3 years and 11 and a half months, so we'll call it 4 years. 28.2% return, annualized rate of return. Now I think that's really good. hopefully you guys do too. Okay. And just in case you're wondering, I always like to compare it to the bellwether. Most folks will say, well, how did it do compared to the market? Which is what most money manager and hedge fund managers will base their success on. Well, we can see the same date, same time frame, right up to the minute. 57, we'll call it 58% on the SPX or the S&P 500, 15% annualized rate of return. We basically doubled. Right? We've basically doubled those returns. Okay. So that's pretty instructive there, I think, when we talk about, again, having the proper setup in place. Okay. So the question is, you can ask yourself. Usually I have folks type it in, but you don't have to type it in. Answer for you. Hopefully you have a notebook and a pad or a pen going, and you can type it in if you want to. But I'll ask you the question. You answer for yourself. Portfolio roller coaster. Would you rather have that uncertainty, or would you rather fill it with stocks that have, again, nothing goes straight up, but has that nice, safer, steady climb? Right? Okay. And then someone actually commented on the dividend portion. Pessy, I think, if I'm pronouncing your name right. All these stocks don't have much dividend yield for retirement income, and that's a great point. That's because we're talking about capital appreciation, and it's the perfect segue for the next core strategy that we're talking about. Right? Safe stocks, ruler stocks don't always pay a dividend. In fact, many of them don't. But thank you for the question because it segues into core strategy number 2 that I want to focus on. So core strategy number 2 is all about, and we shift gears here, there's no doubt that we're going to look at a different objective when we talk about income. So I'm going to begin with what we call the provide portion. Remember our little pyramid. I'm going to begin with the steady income flow from, there's both dividends and covered calls I'm going to talk about. So part 1 is going to be about dividends and some of the basic factors in building a good quality dividend portfolio. So we'll shift gears going from profit to provide. Now, our goal here, of course, is to get paid. always know your objective. And I can't say this enough. When you hit an enter button to enter into a trade or an investment, you better know. It's going to be the cop part of me coming out. You better know what your objective of that trade is. Do not hit that enter button unless you know the objective. So I'm shifting gears here. We just talked about growth. Now I'm talking about dividends. Now you can go out, again, I mentioned earlier, you can go out and get buried by a lot of data. You can go out and try to find good dividend yielding stocks. You can Google it. What's always going to happen, always, most of the time, what's going to happen is that you're simply going to get any of these uh, websites are going to sort these dividend stocks by the current dividend yield, right? As if that is the factor on whether to know you have a good quality, safe dividend growth stock in your portfolio, okay, which is not the case. So that's what happens, regardless of which one you're going through. You can see they're all sorted by yield. So to avoid that, what this is just one of many searches. I happened to create this, did a special presentation on this probably 3 or 4 years ago now, on how to find good quality dividend stocks in the VectorVest portfolio. This happens to be a search called Blue Chip Dividend Payers, one of many that are good quality dividend searches to find these type of stocks. I made it as basic as I possibly could. Dow Jones Industrials, Transports, Utilities, or it has to be in the S&P 500. That's where the stock has to reside. I want a dividend of at least 3%, and I also want stocks that make it to a watch list, well, two watch lists that we have in our program. One is called DRIP 10 to 24, one is 25 plus. DRIP, what does that stand for? Dividend Reinvestment Plan. So all of the stocks on these watch lists have a dividend reinvestment plan. Nowadays, with your broker, the vast majority of dividend paying stocks will allow you to automatically reinvest those dividends, which I strongly urge you to do. So this list has companies from 10 to 24 years, and the DRIP 25 plus. These stocks have grown, not only paid, but grown their dividend every year. And then another very important indicator from VectorVest proprietary number is the dividend safety. This is the one indicator in our program that is not on the 0 to 2 scale. It's actually 0 to 99. We want a dividend safety number for our dividend portfolios to be greater than 50. What that does is ensure us of a favorable dividend payout ratio. In other words, is the company paying out more in dividends than its earnings per share? Be surprised how many companies do that. Now, some do, like closed-end funds and um, some other types, of dividend-paying, REITs, things like that. I'm trying to think of some of the other examples. But some of those, that's what they have to do. But for the most part, any company who's paying out more, if their dividend yield is greater than their earnings yield, something's wrong. Right? So we want to avoid that. That's how we do it using blue chip dividend payers. Here's another example. I'm sorry, let me go back. Let me show you. T. Rowe Price, another stock that I own. It's a great company. What the first thing that should jump out at you, if you haven't already posted this in here, is that you'll see relative safety, right? You're going to say, Jim, you just said relative safety is the most important thing. Look at these relative safety numbers. It's a little different, right? We're talking about a different objective. These companies are mature, well-established companies with a lot of free cash flow. Their relative safety numbers aren't there. Their earnings growth rates are still strong. Their dividend growth rates are certainly strong. Okay, so that's more of what we look at. And you can see the sort on the search. Growth rate time earnings growth rate times dividend growth rate. And then again, let me go back to the example I used. T. Rowe Price. T. Rowe Price is, in fact, a dividend aristocrat. I could go all the way back 25 years in the VectorVest graph here. And you can see what I like to call the golden staircase. Dividends just keep growing and growing and growing year over year over year. Right? The golden staircase of dividends. Okay. I don't have earnings per share on this graph, but they're going to follow that same pattern, and so too does the price of the stock. Okay. Now this is the kind of stock we like to see in our blue chip dividend portfolio. When we build a portfolio based on those type of parameters and finding those good quality, not just focusing on the yield, right? If I look and something tells me it's got a 30% yield, it's probably a $2 stock with no earnings. So I can't be confident that I can continue to get that payout. So here's a picture of, now this is a different time frame. This is a longer term portfolio. It's going on 8 years now. Began as a 5 year, and now I've just continued to track it. Now it goes all the way back to January of 2013. But here's, the type of stocks that currently reside in there. And yes, they do get stopped out. We do have drawdowns. I'm going to comment on the drawdowns in these portfolios in just a few minutes. But we can mitigate these drawdowns as well. But overall, we see a strong move to the upside. That's capital appreciation. That does not include, by the way, right? The portfolio is up 133%, 0.61% to be exact. This screenshot was taken just a little while ago today. Okay. Again, that's over an 8 year period. That calculates out, if you use 4 years, right around 16.9. If it's okay, I'm going to round it to a 17% annualized rate of return. Okay, it's an annualized rate of return over the roughly 8 years divided by the 133.61. Here's the key, though, to what I'm showing you. So that's great capital appreciation on these type of stocks. What that doesn't include, what that 133 doesn't include, and I think I'm lowballing this figure. I had gone through this in reports. I can go through the trade history. I calculated to the penny about it. Oh, it's got to be 2 years ago now. To the penny, I had calculated the dividends that we were collecting in this portfolio. Frankly, I got tired of doing it. It was very cumbersome. I think I made the point. So I'm using 35. I think I'm lowballing it. That's at least the amount of dividends we've been paid over that time frame. Now, if you add those dividends in, you're now looking at a portfolio with 168% gain, right? If we had 35,000 to 133, am I doing the math right? It'd be 168. So yes, I'm rounding these numbers a little bit, or they're kind of static here at this point, but these are the numbers we're looking at. So that 16.9 or 17% annualized rate of return, right, suddenly becomes, when you use that number, it grows to just over 21.25% annualized rate of return, right? Because now we're adding dividends. But wait, there's more. What I haven't done is consider the power of compounding those dividends or reinvesting those dividends. Right? In the back test or in a portfolio in VectorVest, I don't have the power, without manually doing it, of reinvesting those dividends in the underlying stocks that I own. So that would play a big part in growing this portfolio even more. So again, as I said with the growth portfolio, I understand you want to compare it to the bellwether S&P 500 over the same time frame, right up to 11:01 today. The S&P 500 is up 143%. Total annualized rate of return of 18.3%. And so even in what I admiringly and lovingly call the most boring portfolio that I manage, we're still able to outdo the S&P 500 over that long period of time. Sorry, I had to take a sip of water there. Okay, so that's the power of dividends. So that's part one. Let me go through part two here of income. So when we look at part two of provide, steady income from dividends, and now we're going to go part two. I'm going to talk about covered calls. I like to preface this here by saying that I don't know how many folks in the room actually currently trade covered calls. Okay. If you don't trade options at all, or invest using options at all, I don't roll your eyes or step back and say, oh, he's going to talk about options. I can't do this. Covered calls. Covered call is the most used, the most common, and the easiest income trade that there is. Okay. So keep that in mind. I'm going to explain it to you right now. Provide income with covered calls. It's like it's like charging rent to the stocks that are in your portfolio. So what do I mean by that? One of the best definitions, most clear-cut, logical definitions that I've ever come across is from a gentleman named Lee Lowell. He wrote a book called Get Rich with Options. Had a long career trading options as a market maker. And he wrote, I won't read through the whole thing. You can read through that, but I've highlighted the key here. Here's the definition. You need to understand that there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Selling calls is a great way to pad your bank account. Can't believe there are investors who aren't taking advantage of it, and quite frankly, neither can I. Okay. You do not have to be an options expert to understand what I'm about to show you. So, what is a covered call? The simultaneous purchase of an underlying equity and the sale of a call of the same security, also known as a buy rate. And when I'm done with the presentation, I'm going to stay for Q&A. I'll talk a little more about this if you want, but that's when you buy the stock and simultaneously sell or write a contract. Sell and write are synonymous here. And of course, you can also sell one call option against every 100 shares of stock that you already own. Okay. I want to walk through a theoretical example again just to show you the very basics of this. I buy 100 shares of XYZ stock and I pay $60 per share. I go out and I sell one call option. Right? Call options have an expiration date, so I sell it with 45 days to expiration. And I sell someone else the right. Remember the definition I just gave you. I sell someone else the right to take my stock away at 62 and a half at a later date, which is somewhere between today and 45 days from now. They pay me $2 per share to do that. They're paying me to take my stock away at a higher price, which leaves me with an actual cost basis on that underlying stock of XYZ of $58 per share. Okay, that's the scenario. That's the setup. We'll take a look at what's I like to call the what if scenarios here. At expiration of this option contract, which is 45 days later, what happens if XYZ is above the strike price or the 62.50 price tag? Well, remember our cost basis was $58 per share, and so in just 45 days we're able to take in a 7.7% return or $4.50 on the trade. Think of it this way. This is where I'm talking about income here. Think about owning a stock that paid a monthly dividend of 7% every month, not an annual dividend of 7%. Think of it that way. What if XYZ is below 62 and a half at expiration? Well, remember, we paid 60 for the stock, sold the call, so we do have a 3% or a $2 cushion here. So the stock can move sideways. It can even drop a little bit before we start to lose money. Then, of course, if XYZ falls below 58, yes, losses will occur on the trade. But remember, selling the call adds no risk to your trade because the risk is already inherent in the fact that you own the stock. And of course, there will be very strict risk management techniques in place for if the stock does go against you. Okay, so let me show it a little different way. I'm going to scroll through this a little quicker because it's the same idea, just giving you a different visual on this. If you own or buy 100 shares of stock, and let's use Dollar General, don't worry about what the dates or the price. It's the visual I want you to take away. You own or you buy shares of stock, and you do that at $112 per share. Right? That's where you own Dollar General. Let's say at that point you sell a call with a strike price. You would sell it out of the money or a price above where you bought it. Right? So I would go out and sell what's called the strike price is where I agree to let someone else take my stock away at $115. And that investor is going to pay $2.65 or $265 for the right to take my stock away at 115. Okay, that's the scenario, just like I did with the other. What could happen? Stock goes down. The profits from the call help minimize the losses. They don't cover them, only down to for the whatever premium we took in. Stock goes sideways. You can make profits on the call. Plus, you can, if you choose to, and we'll talk, there's many more management techniques that go, but you could keep the stock and sell another covered call against it, continue to generate income. And if the stock goes up, you are capped on the amount of profits you can make, but you get to keep the premium you receive plus all of the gains in the stock up to whatever price you agreed to sell it at. So in this case, at expiration, Dollar General closed at 119. Right? So on our trade, we would have made $300, 112 up to 115 in capital appreciation plus the 265 gives us a profit of 565 bucks. Okay. So yes, the stock did go higher, but remember, our objective was not to watch Dollar General or if we assume we're that good a stock picker that Dollar General is going to go to 150 in the next 30 days. That wasn't our objective, so I don't care how far up it goes. I just know that I captured my max profit and I move on to my next income trade. Here's a real quick example I want to show you. AMD. This little visual I'm going to show started back in June of 19, so it's about a year and a half ago. Right? On June 18th, we bought 300. This was in our income portfolio in our Tuesday coaching group. These were actual trades. On 6/18, we bought 300 shares of AMD, sold 3 covered calls against it. We closed that trade just about a month later and took in $603 profit. That's 6.81 in 31 days, 6.81%. Okay. We did it again. I'm gonna go through this fairly quickly. We did it again here, made another 7.4%. We did it again. We have a very strict technique that we use to do this. Again, another 4%, just 28 days. Okay, we did it again, 5%. This one was just in 10 days. Close the position, open the position again. Okay. Now, when this slide was created, the trade wasn't over yet. I can tell you we made a nice profit from it. Okay, as it turned out, we closed the AMD position another $538. Okay, so if you're not familiar with selling covered calls, again, it's the most common, it's the easiest and most used income strategy there is. There are other great ones, but covered call, if you're managing your retirement portfolio, you should know the power of the covered call because there are other reasons to use it. There are defensive measures and other trades, other objectives, I should say, that come into play when you're talking about covered calls. So a lot of good reasons to understand covered calls. Okay, take a quick sip of water. Okay, finally I'm going to talk about what I believe is the most important part of what we're doing here today, and it's capital preservation. Okay, capital preservation. We're going to talk about protective puts first. Remember our opening quote? Don't just sit there and worry, be proactive. Well, I'm going to walk through in the next few minutes of what you can do to be proactive. Okay. Protecting your portfolio, insuring it. We all use insurance. Just know our goal is to help you protect your assets. Okay. How do we reduce risk? That's really what capital preservation is all about. It's about risk management and reducing risk and protecting your net worth. One great way to do it, buy put options to protect individual stock positions or your entire portfolio. Then we have what we call the option collar trades to do as well. It's just very quickly, that is a combination of selling a call and buying a put. Again, you do not need to be an options expert to understand and be able to employ these important techniques. Look at it this way. You have to insure yourself. You have to insure your assets, right? You have homeowners, life insurance, car insurance. Heck, I always say my wife and I, we even have insurance on our two dogs. Right? You have an asset. Insurance simply protects against damages to that asset. Okay? So we're going to focus on using a put option to do that. Now, I'm going to walk through a case study. Again, don't worry about the stock or the time frame here. It's the visual I want you to take away. Let's say you really wanted to be defensive. You own Texas Instruments. Okay. Maybe you bought it on this. This is a confirmed up call. Heck, maybe you bought it way down here and you've got a huge gain. We'll use this one for now. Okay. For whatever strategic reason that you need or want to protect your portfolio, you could go out and simply buy a put option on Texas Instruments. What does that mean? What a put option does is give the buyer of the put option the right to sell his stock at a certain price by a certain date. Okay. In this case, what if I bought the right, because Texas Instruments is trading at about 120 right here. I could buy the right to sell my shares, my 100 shares of TXN at $120 per share, which means I would be covered no matter if the stock went down. Okay, I could buy the right to sell it at 115. Again, it's an insurance policy. It's going to be less expensive because I have a deductible to my insurance policy. And I'm going to walk through the exact process of this right now. Let's do the case study. So we bought Texas Instruments. We'll use this date, November 24th. Confirmed up call came. Good quality stock. We buy the stock. Okay. The stock, a couple of months later, is trading at right around 120 or roughly 20% return. This is an unrealized return. Now the key here is I want you to look at this as though I know we own the stock. We said down here around whatever we said, $90, $94, $95, $100, whatever it was. But when my stock goes to 120, yes, I know it's an unrealized gain, but in my mind, I own that stock at 120 now. It's my stock, it's my money, and it's incumbent upon me to protect it. And it's incumbent upon you to do that. So, we do our due diligence on every stock that we own. 1 week prior to earnings, we want to protect that unrealized gain. What could I do? I know I could just sell the stock. Okay. I'm sorry, I was reading a question at the same time. 1 week prior to, we do our due diligence. We know that earnings are coming out on the stock, and so we have to be proactive. We have to do something, anything about what's worrying us. I know you could sell the stock. Don't type in just sell the stock. Okay. We're talking about a retirement portfolio. If you want to just rebalance 10 or 12 or 15 positions every 90 days by selling a stock just because earnings are coming, you can do that if you choose to. So we're going to buy a put option. In this case, it costs $4.23 or $423 for one contract. What happens? Well, Texas Instrument gaps down after earnings. Okay, even a good quality stock can have some bad news in their earnings announcements. So the stock gaps down. Well, what happened? Remember, we have the value of a put option goes up when the value of the underlying stock goes down. So because I have the right to sell my stock at 120, that value is now of this put option is $1,128 per share. I have a damaged asset, but this insurance policy covered it. So had I not bought insurance, my $2,000 unrealized gain would have been cut in half. Right? I didn't need to live through that catastrophe. I'll continue with the quote. $1,000 of the profit are gone. But had you bought the insurance as I illustrated, we would have made roughly $700 on that put option, would have mitigated our losses, and after the earnings announcement, we would have been down 1,700 instead of 1,000. I'm sorry, 300 instead of 1,000. Okay. It's an insurance policy on Texas Instruments or on any stock that you own. That's all it is. Okay, you drastically minimize or mitigate your loss. So let me ask you, would you rather be able to protect and insure your net worth or simply go on just hoping that, yeah, I think I bought a good stock and I think it's going to continue to rise and yeah, I'll worry through these tough times, but I'll be all right. Which would you rather? I'm going to make you type this one in. Which would you rather have? Would you rather have insurance or would you rather not have insurance? Yeah, Donald says insurance. William says protection, of course. Ed says Mark, Stephen, Brett. Yeah, I mean, I know the answer. I just want you guys to. Okay, great. Yeah, of course. Of course we would. Now, I want to talk quickly about not only can you protect your individual positions, but of course we can protect our overall portfolio. So here's another, I'm going to make this a quick example of how you can protect an entire portfolio of stocks that you may own, right? Why, when would I want to do that? Well, for an individual stock, usually it's for earnings. The clearest reason to want to protect your overall portfolio for us here at VectorVest is the market trend. So a confirmed down call or a DEW down call. This this slide I had actually created preparing for a different presentation. This was before the sell-off of the pandemic. This was first week of February. The market was going straight up, and I was getting worried that everybody just from my interactions with folks in our coaching group and other courses, the market's going up, it's going up, 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 and it's never going to go down again because everything's perfect. Right? I'm exaggerating a little, but that's the feel that I got. So I was becoming pretty adamant in the fact that you cannot look at this move to the upside without remembering this. What is this? Am I pointing at? I know in this day and age, it's easy to think that October of 2018 is forever ago. But you may not remember there was almost a 20% drop over a 3-month period in the S&P 500, and everyone seems to forget. So I didn't want to look at this without being prepared to protect myself if this happened again. Why? Because it took over a year for that run to occur. Yes, it broke above, it pulled back, but over a year to get back to even. That's time use of your money that's wasted. And you shouldn't have to live through those drawdowns. Okay. So I'm going to zoom in. This is now what we're looking at is a zoom in of that graph. And I'm going to zoom in even further. This was February 24th of this year. We all know what happened that week. Okay. Our DEW timing system, which is how do I want to phrase it? Our second most prudent, market timing trend versus the confirmed, which is our overall slowest trend. But the DEW, which we like to use a lot, went down on February 24th of this year. That would have been a good time to be proactive about what might have been worrying you. So we could buy SPY, that's the ETF that tracks the S&P 500. We buy put options. Okay. If you didn't do it on the DEW, you certainly would have wanted to do it on the confirmed down, which was February 28th. You needed to be proactive, and we gave you 2 very specific dates to do that. Buy some put options on the SPY. Cover your entire portfolio. Here's a quick case study. I'll start with the DEW. The signal went to a down situation, a good time to become defensive. This is just a theoretical purchase here. This is not one that, although in our retirement coaching group we do trades to protect the portfolios, this is a theoretical trade. On that date, an at-the-money put option, SPY was trading at 322. I could have bought one contract or the right to sell 100 shares of SPY at 322 per share. I would have paid $9.75 for that contract. Okay. I don't know, not how many days later is that? 2 weeks, 3 weeks later. On March 13th, that same put option was worth $71 per share. Now, I'm not saying you would have held it right to the low of the put option value and that you would have captured every penny of this. That's not what I'm trying to say. Following our techniques, you would have bought it up here somewhere, but you would have gotten out here or anywhere in this range. You would have greatly mitigated your losses. Okay. Then I show a quick one from the 28th. If you had waited for the confirmed down, right? Even then, now you would have paid more. Now the SPY just 4 days later is now down at 296. If I bought an at the money put at $14 per share, that's my insurance policy. Less than a month later, that same put option is trading at $67 per share. And as we know, this was right at we didn't call this, but I'm just recalling that this was the bottom of the market. Again, you didn't have to hold it right to here. You could have sold it anywhere in this range and greatly mitigated the losses in your portfolio. Here, a measly 379% return on investment. Okay. So when we're able to apply that, what we're able to do, again, portfolios will never go straight up. We see it in October of 18. A lot of people forget January of 2018 and late February into February of 2018. October of 18, obviously the most recent one. You have to be prepared to protect your net worth. What I just showed is a great way to mitigate these drawdowns. You have to be proactive. Elaine was kind enough to send us a note, and as I always say, these kind of things mean, a lot to me to know that this worked out. Elaine said, Jim, because of your teaching, I hedged my portfolio. This is way back. This is the 2018 one. Right? He invested $835 in insurance, and with one of those catastrophic moves to the downside, was able to mitigate that loss and profit greatly from that put option. And so always good to see that goes into effect. Okay, this was the January sell-off. Again, I know a lot of folks don't remember, but that was a pretty rough few weeks in the market. So we talked about capital appreciation, income, capital preservation, the three core strategies. Just to give it a quick review, we talked about the growth portfolio using ruler stocks. Okay, nearly doubling the performance of the S&P 500 over the same period of time. I talked about the dividend portfolio. I think I saw a question come in. We're up $133,000 in capital appreciation on a $100,000 portfolio. Right, that's nearly 17% annualized rate of return. What's not calculated is another 35 grand. So I add that in and I say, okay, if I were able to take that money and it sat in my portfolio, the value of this portfolio now would be 168,000. And I'm rounding this number. I'm lowballing this number. Right? But somebody type in, correct me if I'm doing that wrong, but 35 grand would give me $268,000 value, or $168,000 or 168% gain. And that doesn't even include reinvesting. Anyway, that gives me 21 and a quarter, again outdoing the S&P 500. And then also, as far as income, we talked about AMD and a great way to generate safe, steady income. Okay, we talked about defensive measures in the market and for individual stocks and how important that is. Okay, so those are the three core strategies that we believe here at VectorVest are the three core strategies every retiree must understand and implement so that they can grow their portfolio, generate income, and preserve their net worth. Okay, that's in a nutshell. Okay. So I would ask, ask yourself really, how can I implement the three core strategies right now to help begin or at least start the foundation of building and managing my portfolio? Okay. Well, it's time to make a choice. You can do it alone, but that could take a while. Plus, when you keep doing what you're already doing, you may end up seeing the same results, and maybe they're not good enough. Okay, maybe they're just simply not good enough. Right? If you're not getting close to what I'm showing you here, I don't think they are. You can do it on your own. You do trial and error. You'll be learning that way, which can lead to making mistakes and missing out on those strategic times to protect your portfolio. Okay. Instead of going through that trial and error and through that maze, you can take a shortcut. Okay. And you can do it by using a system that I know works, that I've helped to create and have used here for more than a few years, and that is the Ultimate Retirement Solution course, using the 3 core strategies to protect and grow your nest egg. It's designed to take you by the hand and guide you through the method you need to grow and protect your retirement account so that you can retire with peace of mind. I'm going to take just a second to walk through the Ultimate Retirement Solution course and let you know, break down how we walk through the different modules. Well, there are 6 of them. And first, you have to lay a clear path to victory, we say. It's very important to understand your goals, to have them written down, to know what I like to call your vision statement. You have to have defined objectives, portfolio allocation, and clear goals. That's what we do. The rest is meaningless if you don't have your objectives in place. Module 2 talks about the stock buying checklist, balancing your portfolio, making sure you're not over invested in any one industry or sector, setting up your risk management plan, your exit strategies, if you will, and how to buy the right stocks at the right time, as I showed earlier. Module 3 does the same thing, only it shifts gears and talks about building your dividend portfolio. Okay, so modules 2 and 3 will walk you through the exact process, the stop criteria, the risk management we use for those. Modules 4 and 5, I think, are the most important here. Again, if you don't trade call options or sell call options or ever traded options at all, do not be put off by the fact that I'm even using the term options. I believe it's imperative that you understand protective puts and selling covered calls if you are taking on the responsibility of growing and protecting your net worth. You have to know how to do these 2 things, and they're very basic. I showed the covered call. You can do it both as an income generator and as help in protecting your portfolio. Everybody remembers the Strategic Defense Initiative back in the 80s President Reagan had? Well, that's kind of what I try to set up in Module 5. Be prepared. Know what to do. Know how to protect your portfolio. Understand how to see and define those defensive times where you need to be employing insurance. And then finally, we'll talk about, in Module 6, we'll talk about allocating funds, we'll talk about portfolio automation, and we'll go through the actual process. Kind of takes us from Module 4, where we'll build an exact trading plan, and I can show you real quick. This is the result of that. This is from our Tuesday coaching group, using a very specific trading plan. Right? I have a journal of our trades that we've done, and just so you know, we've used about $50,000. We have over $10,000 gain with just about 80% winning trades, doing just 1 trade a week. We do 1 trade a week, and we're up over 20% on the year. And just to give you an idea, AMD, I told you all those AMD, these are all those AMD trades that I was talking about. Actually, these are newer ones. The others were from these are from this year. Okay, every one of these AMD trades, we're generating a nice income, and we have a profitable one open right now. Right, I can show you. Here's an AMD trade and Lennar home builder trade. Okay, that was just placed last week. This one was placed yesterday. Okay, these are actual trades that we do. Okay, so that's the module. That's the course itself. There's some great bonuses that come with the course if you decide you want to take the time. One of our bonus is the live mastery support sessions. So those modules I just showed you are archived in the digital course. Very easy to get to. I'll show you before we're done today. What we do from those modules that you have access to for 1 full year, you can look at them, study them. We have quizzes. We have resource videos within each module. Then we'll have a live mastery session to help implement what you learn. Okay, look at what you're doing if you have specific questions. And if you can't make the live session, the live mastery session, which I'll give the dates to in a few minutes, if you can't make it, don't worry. You can submit your questions via a dedicated email bin, and we record and archive these as well later on that afternoon. So you can always follow that. Here's my favorite part or favorite bonus that you guys get. It's 6 weeks access to our retirement coaching group. You heard me mention that a little bit earlier. I showed you two of the important pieces of what we do. Our weekly buy right trade. Okay, we have again about 80% winning trades right now, and we're up over 20% in the portfolio. So we'll walk through the process. You're invited to this separate coaching session for the life of the URS course. You can access our portfolios, how we manage them, and every Tuesday at 2 p.m. Eastern Time, we have this live session, lasts anywhere from an hour to 90 minutes. And this we will also record and archive for you. So if you can't make the live one, you're still able to get in. We're going to give you another bonus module because as great as covered calls are, there's another way to trade options for income, and it's using credit spreads. So our friend and colleague, Mr. Ron Wheeler, nobody better at it than him. He's going to give you a bonus session on how to open up another income stream. So you get a full session with Ron with high probability trades that he'll walk through on selling credit spreads and generating income. A very good, safe way to do that. So that's another bonus. Finally, if you happen to be in the room and you are not currently a VectorVest subscriber, we'll give you access to the VectorVest program for 60 days. Okay, that's for new accounts only. Come in and join. Okay. All right, that's not the slide I want. Here's the slide I want. Okay, order before the end of the webinar, and I'm going to take as many questions as long as there's people in the room. I'm going to stay here, answer questions. But if you order before we close out the webcast today, you get what we call a fast action bonus. There are 3 price points on the course. $7.95 is the price of the course. Right. We have what we call an early bird special at $5.95. But if you act now, we'll give you that fast action bonus, $495 to join me for the 6 modules, 6 live mastery sessions, and Ron's bonus session, as well as the 6 live coaching sessions that we'll do. That's a lot of time, a lot of resources, a lot of information, right? Where one covered call trade will pay for the whole shebang. Turning into Glenn, I just said shebang. Okay. Okay. If you go to www.vectorvest.com/URS, and my colleague John was kind enough to type it into the chat box, if you just simply click there, okay, if you click on what John wrote in the, or go to the link, here's the page you'll come to, and it is the Ultimate Retirement Solution course. Actually, what I say, $7.95. The price actually $9.95. $4.95 is what you'll get, and we'll even come on and help answer any questions that you might have. So you can purchase the course. It'll give you a rundown of all of what I just talked about. Okay, you can hit purchase course now, and you can sign up for the $4.95. Okay, a lot of bonuses, a lot of resources that go. You get access to the course for a full year. Okay. Now, here's the important part. If you're considering doing that after the course is over, if you show you've done the work, have come to the classes, watched the recordings and so on, and you're still not satisfied, I put you, will gladly give you a refund. That should say we or we, VectorVest, will gladly refund your $495 if you are not 100% satisfied. So how much is it costing you not to do this is the question you have to ask yourself. How much money will you lose? How much potential profit will you leave on the table? How much time and energy will you spend trying to do all this on your own without a process or a plan? Then ask yourself, how would life be different if I follow these strategies and implement them properly? How would life be different if I do that and it works? Well, they say there's no such thing as a risk-free trade in the markets. Well, this actually is. Take the course. You don't like it, we'll give you $495 back. It's not too late. They say the best time to plant an oak tree is 20 years ago so that you can be sitting under it now enjoying the shade. You know, and the second best time to plant that tree? That's right, today. So it's never too late. It's not too late to begin planning for your retirement, and it's never too early, certainly, as well. So remember, for just $495, you have a risk free money back guarantee for, let me tell you again, 6 modules, 6 live mastery sessions, 6 live retirement coaching group sessions, plus all the videos and resources that are found inside the course in a dedicated email bin to help us quickly answer any and all of your questions. And usually someone will ask, when are the live sessions? I've got a list right here. They begin Monday the 23rd, and they go every Monday at noon Eastern Time for the next 6 weeks. And then you start the new year off with your bonus module on January the 4th. And that's the calendar for those modules there. So again, vectorvest.com/URS. Um, at this point, what I'm going to do is stay in the room. There's still folks here. I will answer any and all questions. John will help me out with questions as well. Um, so let's do it this way. I know John has answered a lot of questions. John, if you could point out any questions that I might be missing, I'll try to go back here and do this. If you have a question about anything we talked about today or in the course, we have a lot of chats in here, so you might want to go ahead and type it in. If you can type it in again now, we'll be sure to get to it without trying to scroll through and peek at it. So, John, I'm going to take a sip of water and see if there's anything I can help these kind folks with. Okay, maybe John's not there.
Oh, I was muted. I was
Okay, yeah,
talking.
yeah, it happens to us all, John. You know that.
All right. First question. Actually, a couple of people were asking about this. The two people that were asking, Rudy and Nectarios, are in Canada,
Okay.
but I'm assuming this would apply to other countries. What if you're not in the US?
Yeah, that's a great question. We get that. We get that a lot. The concepts that we apply here, especially in modules 1, 2, and 3, apply anywhere in any of the countries where we have our database in our VectorVest system. Uh, the covered calls apply as well as the protective puts. The one factor that I comment on is that understand that in Canada or perhaps in some of the other countries, the option liquidity is not always as easy to find as it is in the United States. But if you're filling your portfolio with these type of names, whether it's in the UK or Canada or in Australia, and you and these are the bigger names in stocks, you're most likely going to be able to apply covered calls and protective puts. But I will say it's not always as easy to find the best candidate. So that's my one caveat, I guess. So the short answer is it applies everywhere. The option portion does apply, but with a little more work to be done. Okay, and then I do see Stephen saying, "Ask, please give me the link again." Stephen, the link was typed in the chat box. It's right there on the screen. It's www.vectorvest.com/URS. Okay.
Okay, next question here is from William, and a couple of other people have that general question. Is there a minimum dollar amount that you want to have to be able to take advantage of these trades
Yeah,
and
that
investment plans?
Yeah, that's a great question. We get that one a lot too. You know, how much do I need to be able to implement this? And it's funny. I just was talking with a younger cousin of mine just last week, and he was asking me the same question for his real time portfolio. It's a difficult question to answer. You've seen me talk about these portfolios. These are all these are all theoretical. Some of them are real, and my own portfolio is real. But we use these portfolios. They're all $100,000 portfolios. What do you need to do this? Um, Listen, I think you can do this with, and again, it's hard to put, that's why I'm hesitating. It's hard to put a number on it. But let's say you have $10,000. Okay, and I'm just throwing a number out there. And you buy you use ruler stocks. Yes, they're expensive stocks. And maybe you buy three positions and put $3,300 into each position. The percent return is going to be the same depending where you are, how much cash you have, what your time frame is. Unlike option trading, it's very difficult to, you don't need a lot of money because you have the leverage. But here it is about, purchasing equities. So what's my answer to how much you need? If you got anything above 10, 15, 20,000, and you're looking to grow that over a period of time, you can do that. You can do that.
Okay, Jim, just to reiterate from Michael, are the class modules live?
Yeah. Okay. Yeah. Great question. The modules are actually recorded, and let me. I should have had it up. I apologize. I'm going to pull it up here very quickly. I'm going to pull this up. This is what it would look like. You go to university.vectorvest.com. Okay. And I'll go to my dashboard, and hopefully I have this open here. You see, I have all the courses, of course, but 2-day investment, ultimate retirement solution course. There, see, and somebody's always here to help. Um, Ultimate retirement solution course. If I hit continue, okay, here's what it's actually going to look like when you join. I'll start right up at the top. We have a welcome video. We have each module that I talked about just a few minutes ago. And within each module, you have the actual presentation, which is recorded. Okay, so if I clicked here, this is uh, this is the recording of that module. Okay, price appreciation. We then have the live mastery session entered after that Monday afternoon, later that day. We have videos built in, walk through videos, because we do give you homework assignments, and we'll actually have videos to help you walk through it. We have that for all the modules. We then have our bonus module, and you actually even get access to a live stream version. We did the entire course in one day. I did, and John and I did, and we recorded it and have it up there for you. You also, in the resource section, have access, of course, to all of the slides as well. Okay, so that's what it looks like there. So the short answer to your question is the modules are all recorded, the mastery sessions are live, and then archived later that day. So hopefully that helps. Okay, great. We'll keep trying to hit a few of these questions here. By the way, while we're looking at questions and stuff, if you've entered, let me know that you were able to get in there and use the link. Just type in "I'm in" if you were able to get in. Let us know, and I'll tell you what you can expect is an email from us, um, giving you all the instructions on how to sign up. William says that he's in. Fantastic, William. Welcome. Keep an eye out. Michael's in. Um, you'll get an email giving you all the instructions you need to access the course. Al's also in. Fantastic. Thank you, Al. Um, Madi, if I'm saying your name right, I hope. For how long do you have access to the course material? Great question. 1 year. You have access to all that I just showed you for one full year. Okay. And by the way, the what I forgot to also show the retirement group coaching sessions, all six of them that you are invited to, will also be placed here. So these are the ones from the last course. You'll get new ones in there. So you also get access to the live versions. I meant to say.
Hey, Jim,
Yes.
can you kind of give a brief walkthrough of entering the order, just the basics of it when you click on that link? I think
Sure. Yeah.
Steve seems to be having some problems.
Yeah. Let's walk through and make sure you can get through. So what I did was I just clicked on the link that John put in to the box, to the chat box, which again is vectorvest.com/urs. We have our special price. This will be available probably for about another half hour or so. So just go ahead and click purchase course now, which will bring me to my VectorVest order and let me know what the price is. I'm saving a bunch of money. Hit proceed to checkout. By the way, you saw elite members. If I think I saw correct, if any of you are elite members, just do what I'm doing now. It's actually cheaper than the elite pricing. Otherwise, give a call into product support or follow that link that was up there. Okay, so when you do that, you first put in your basic information here. Okay, and then you would hit
Jim,
submit. Yeah,
no, 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 no.
yeah. Hang
Okay,
on.
sorry.
Yeah, let me take a step back. Let me take a step back. I'm sorry, that was my fault, John. 495 is the price. Okay, you can log in there. Let me walk through that the way I should have. Proceed to checkout. If you are already a current subscriber to VectorVest, simply click sign in. Okay, that will bring you eventually to this page here, where you'll fill out and just follow the instructions that are there. If you are already a member, that's all you have to do. If you are currently not a VectorVest subscriber, choose proceed to checkout. Whoops, I guess I already went too far with that. If you're not a current VectorVest subscriber, just simply fill in your basic information and it will walk you through the prompts. Okay, so if I hit proceed to checkout, I've already gone through, so it knows I'm in here. Okay, sorry, John, I screwed that one up a little bit, but I'm getting old.
That's okay.
Bobby's also in. Thank you, Bobby. Good to keep an eye out for that email. It'll give you all the instructions. Any issues on getting in, don't forget, just call product support and they'll walk you through whatever you need. 7638. I just put that number in the chat box, 888-658-7638. That's if you have any issues. If you've got any problems or anything, you can give them the call. Be patient with them. That's probably a little busy out there, but they'll help you out. All right. Let's see. Scroll down. Again, I'm happy to. There's still a good amount of folks in the room. I'll hang on. So, uh, and here's one Theodore asked. I know John answered already, but it's a great question. Can you go through the modules at my own pace and go back to the scheduled live sessions? And Theodore, yeah, all 6 modules will be available to you shortly after you go in and sign up for the course. Okay, those modules will be available to you. And so you can kind of get ahead, you at your own pace, and then come back in and again, we have the dedicated email bin. You can send questions in there and do whatever you want to do. Um, Here, Stephen.
I'll just put in his account a comment in there so they can be able to do that for him.
Oh,
Jim.
okay, perfect. Yeah, Stephen.
Yeah.
Well, yeah, thank you, John. All I was going to say, Stephen, is don't worry. You get the price promised for being here today. Okay. If you're having technical issues in your account, uh, John and John is much better at it than I am. He'll make sure that you're entitled to the price for being here today, so you'll get that. All right, let's see. John's asking, how do I register? Um, once again, John, if you go to this website right here, this vectorvest.com/URS that was typed into the chat box, you can actually just click it. When you click on that link, it will bring you to this page where you can simply enroll today for our very special price of just $4.95 and just hit purchase course now. Okay. When you do that, it will bring you to this page where again you're saving a great amount of money there. Hit proceed to checkout. Now here's the page I lost earlier. If you are new to VectorVest, if you are not a current subscriber, simply fill in this basic information and hit submit, and it will guide you through a couple of basic steps to sign up. Remember, you're going to get there's a there are um, VectorVest and some of the add-ons that go with it. So just go through. It'll prompt you through that. If you're already a member, all you have to do is click sign in. So John, hopefully that helps. We'll be here for a few more minutes. If you have any issues logging into that site, please let us know right here. But that's really all you have to do. And again, I put the in the chat box the product support phone number. Again, just be patient. Sometimes the calls come in, and you may have to be patient just for a few for them to get on the horn with you. Okay. So one of the things that I really look forward to, from the course, and you guys can look forward to coming into the coaching group sessions. Again, we've got some great winning trades. We had one trade to this day that's still bothering me that I allowed to go down that much, but we have again just about an 80% winning percent going um, with without ever really using more than $50,000 on positions. We do one a week, so we never have a full portfolio. So we're never uh, prone to that big drop down day. That big somebody mentioned black swan earlier, some headline that tanks the market. So because we do this safe, steadily income growth, is that we don't get hurt. As you see, actually, we have a net ease trade on as well. That's not showing up in this one. These are our buy rights. Okay, we have a very specific plan to take care of those. We also have uh, portfolios here where we illustrate how to do a collar trade. Teradyne is a great stock we own. It had earnings. We placed a collar trade to illustrate how to protect it. Logitech was another one. We sold covered calls against to generate income, lower our cost base. This wasn't a buy right, it's just a stock that we owned, and we sold covered call to protect it and generate income and lower the cost basis. Okay, so that's what we do in on the Tuesday sessions. You can have access to all of the processes and plans that we use there. Okay, that's on top of the course. That's not even the course. That's just the 6 sessions in the coaching group. I mean, the coaching group alone, 6 sessions in the coaching group alone, and one profitable covered call trade covers it all. All right. All right, I'll give it 60 more seconds, John, unless you see anything else. We'll turn the timer on, 60 seconds, and we'll go ahead and wrap up today. Before I do that, of course, thank you all so much again for taking the time to be here. If there's anything we can do, you just let us know. Kobe had a question here, a little wordy. Let me see if I can read through it quickly. Kobe, I'm just trying to read through it. Kobe says, I used contra ETFs to protect my portfolio most of the time. I lost money. I will try now to buy a put on the SPX or the SPY. Kobe is the ETF that we use. What do you think is better, buying puts or buying contra ETFs? Um, Kobe, actually, I think that buying put options is a better way to go. It's not. Listen, contra ETFs are not a terrible way over time to protect your portfolio. Okay, I personally wouldn't want an entire portfolio of contra ETFs. I would never do that. The great thing about put options are, first of all, the leverage costs you a whole lot less than going out and buying, ETFs. Um, it's shorter term, so you're not, beholden to hold that long enough to try to get the profit. Keep this in mind when we talk about buying protective puts. It's okay to lose some money on a protective put. Okay, this is one of the things I didn't emphasize the way I usually do earlier in this presentation. I don't worry about losing a few bucks with a protective put. The analysis I use when we talk about insurance, and the analogy that I use is every the 18th of every month, I go into my bank account and automatically I pay Geico as my insurance company, who happen to be wonderfully great, by the way. So I don't own Geico stock or anything, but they're great. But I go in there and I see that I've paid my premium. Now, if you do that, or when I do that, I don't get mad that a tree didn't fall on my car this month and I needed to use my insurance. Yeah, I pay the premium, but I sleep better because I know my house, my car, my life, my dogs are all insured. That's what a protective put option is. So that's why I like them much better than the ETFs. And I'm not saying you can't ever use ETFs and there's no strategies behind that. I'm not saying that at all. I'm saying of the two, I'd rather be aware and understand how to use protective puts. But a great question, and you are welcome. All right, folks, www.vectorvest.com/URS. That price will be good, like I said, probably for another 20 minutes or so. So go ahead. Hopefully, you'll take advantage of it. It is risk free. If you don't like it, you get your money back. So I'd love for you to take the time, and I'd love to see you starting. What is it next week? The course is launched next week, and then our first mastery session is on November the 23rd, Monday at noon. So I'm hoping to see you guys there. John, thank you for helping out in the background. And to all of you who are still in the room, stay safe, stay healthy. And I look forward to seeing you at that first live Monday session on November 23rd. Thanks, everyone.